If I keep cap rate where it is right now, or I even go lower in the cap rate, like you will see some of the syndications that are marketed do that, the returns are sky high. But what is the basis for making that kind of assumption? Have you ever wondered how real estate syndications actually make money? It's simpler than you might think, yet incredibly powerful when executed properly. Now, it all comes down to increasing the value of the property through strategic renovations and operational movement. It's called a value add. And when we purchase an apartment building, it's typically in need of some updates. Maybe the units need modern finishes, or the community could benefit from new amenities like a gym, dog park, or some upgraded landscaping. And so completing these renovations, we're able to charge higher rents. And this directly increases something called the net operating income, or NOI. Now, why is this so important? So in commercial real estate, the value of a property is determined by its NOI, by its income, and the local market's capitalization rate, or cap rate. So in other words, commercial real estate, the more money it makes, the more valuable it is. It's like if you were to buy or value a business, the more profit it makes, or EBITDA, the more value it is. So NOI is similar in that regard. So for example, if we purchase an apartment building with an annual NOI of $500,000 and the local cap rate is 6%, then the value is the NOI, $500,000, divided by the cap rate, 6%. So in this case, 500,000 divided by 6% is 8.33 million. Now, let's say over 5 years, we make these strategic renovations. We implement this value add plan. We modernize the units, we improve the amenities, and make the property more attractive to higher paying tenants. And as a result, over time, we increase the rents and grow the NOI to $800,000. Now, at that same 6% cap rate, the property's value now is $13.3 million, right? It's $800,000 divided by 6%. That's a $5 million increase in value just by improving the property and increasing its NOI. But it gets even better, because when a property is renovated and in better condition, it often commands a better cap rate. In other words, investors are willing to pay a premium for a property that's been improved, right? So it's pretty simple. Let's say you have a rental property, okay, and it's in a really, really bad area. Well, the bad area, it's more tedious, it's maybe more risky. So in order for you to maintain and own that property, you might be looking for a higher return because it's in a bad area. Versus if it's brand new in a beautiful neighborhood, you're like, yeah, this is pretty good. It's not really much work. It's very nice. I like being there, so I will put up a lower return. That's why the value is often changed, and that's why the cap rates are a little bit different. So if you make something that's maybe not so nice into something nicer, typically what happens is the value by doing that actually increases as well. So let's look at the same example with a more favorable cap rate of 5%. So the inverse relationship, the lower the cap rate, the higher the value is. So we went going from a 6% cap rate to 5% because it's a nicer property, and so you would expect that to go up. And indeed it does. So with a new NOI of $800,000 and then now a new lower cap rate of 5%, the property's value now jumps to $16 million, up from 13. And that's almost to double the original purchase price of $8 million, all from renovations, operational improvements, and strategic management. Now, cap rates aren't just about the property. They also depend on external factors like interest rates and the yields on the 10-year U.S. Treasury notes. But that's why, as in syndicators, we always take a conservative approach when modeling our projections. So, for example, in our latest deal, CoStar projects cap rates will decline to 4.75% when we plan to exit in 2029, but we're modeling a more conservative 5% cap rate to ensure investors' return are realistic and achievable. And by the way, these small differences in cap rate make a huge difference, as we saw in a previous example, going all the way up to $16 million. So 0.25%, it makes a big difference, right? If I keep cap rate where it is right now, or I even go lower in the cap rate, like you will see some of the syndications that are marketed do that, the returns are sky high. But what is the basis for making that kind of assumption? And so the best part is, while we're increasing the value of the property, investors also benefit from the cash flow, not just the appreciation. Now, this comes from the NOI after expenses being distributed to the investors during the life of the investment. And this means that even if at the end of the hold period, it isn't a good time to sell, we can hold the building for a few more years and continue to collect cash flow. Now, at the end of the holding period, when we sell the property, investors receive their share of the proceeds, including the gains from the value we've created. So this combination of cash flow and value appreciation is what makes multifamily syndications such a powerful wealth building tool. And it's why we focus on these value add opportunities in these value add multifamily properties. It's kind of a proven strategy, cookie cutter approach that we've done over the years. And it not only generates strong returns for investors, but also improves housing for tenants and communities as well. So it's real value creation for everyone involved. And for you as an investor, you get to build wealth completely passively while we handle all of the work. So if you'd like to learn more about investing in real estate syndication, then check us out on nighthawkequity.com. There's a free mini course on there. If you're really new to syndications and it's an hour too long, you just learn all about what it means like to invest passively in a real estate syndication. And if you are actually actively looking for opportunity, there's a chance for you to join our investment club, and we'll share with you some of our upcoming opportunities before we market it to anybody else. So either way, hopefully that's a good next step, and I will see you next time.